22nd of March 2023, Wednesday. All right, guys, this is getting crazy. A massive credit crunch is going to happen very soon. I know that, guys, probably a lot of people think that I'm fear-mongering. I'm basically telling people all the negative stuff throughout. But you must understand that if the situation is not good at all, it is pointless to call for buy at every dip. Now, of course, at every dip, if you buy some and the market rebound, like recently the Dow recovered 1,300 points, yes, that's a good lot of money. But the thing is that if you wake up and there is a sell-off in your stock or there's some problem surfacing and that's something that you can control, that would be terrible. And in fact, it's right. I just realized a few companies are all gapping down because apparently either their operation has stopped or apparently it's right. There's some situation happening. And likelihood is because of credit crunch. That means that the banks has sent them a email or a letter and tell them that, look, we're not able to provide you with further funding or we need to pull back the funds away from you. This is what I mean by credit crunch. I'll tell you more in detail because this is going to affect everything across the board. This is a must-watch video. Let's go. Now, once again, guys, thank you guys for all the contribution. I really, really appreciate that. This place we're going, right, it's going to be at Paragon Shopping Center. And of course, as long as you basically leave a comment that's related to the video that you watched like today, you will be entitled to a chance to spin the wheel and lunch with me next Wednesday. All right. And of course, this particular restaurant is a 4.5 stars rating on Google, 780 reviews. And very important thing is this, guys, I need to clarify. Yeah, the restaurant is not a sponsor. Apparently, right, it is from my very own TWB student who are sponsoring this, okay, because they made money in the market. They want to assist me in the marketing. So they say that I told them this, look, why don't you just sponsor for my this spin the wheel lunch with Kel thingy, and they're coming forward to do that. All right. So yesterday, more people came in to start to review. I really, really appreciate that. And JL, you want me to talk about the which stock could be the problem, and that is something that I compiled for you today. So watch out for that. And of course, thank you, EP, for the recognition of my homework of the history of recession. I hope that I could have done a better job yesterday, but I know there's certain things I can say, certain things I can't say. So all I can say is this, hope you understand. And of course, guys, I never knew that you can buy views from the internet. Okay, something new. I didn't know that. So, but I won't do that anyway. And of course, Augustine, all right, your mentor using Chiman. Well, apparently, as what I said yesterday, you got it correct. Now, it seems that, right, the bigger banks are being forced to, to save the lousy bank. But you know that is actually one part of it. But you think carefully, is all right, the deposit where the smaller bank has now going back to the bigger bank. So end of the day, so the bigger bank actually get advantage of this. Of course, as long as the government support, like example, like UBS is supported by the Swiss National Bank. So of course, the government is going to support UBS. So that's why UBS no choice had to go in to save Credit Suisse. But I say again, all these are just going to be part and parcel of a very big thing going to happen, because I believe that a major bank problem will surface pretty soon. Because why? History always rhymes. All right, once again, thank you guys for the subscription. Recently, the numbers are increasingly a little bit faster than usual. Yeah. Now, I don't do much marketing, but I still appreciate it. So if you like and share and subscribe, right, once we hit the 1,000 subscriber, I will offer a solid thank you celebration. So guys, quickly forward and share if you think whatever I shared is pretty good. Okay, thank you. Now, food prices is going up. Apparently, now this is coming from Channel News Asia. Apparently, like the chai peng store, the mixed vegetable rice. Yeah, I identify in my area. Sometimes I basically buy the same thing. It could be $5, it could be $6, it could be $7. But of course, the size of your meat does vary. And of course, the day they go to the market to buy, and of course, these people, they also have get various prices. We can understand that. But still, now, a mixed vegetable rice with 1 meat and 2 vegetable costs easily $6. Think about this, guys. We were like $3.50 back then, just 1 to 2 years ago, and now it's $6. So imagine if the interest rate continue to go higher, then what will happen to this cost? And next, if unemployment begin to hit everyone across the whole world, what will happen? I cannot imagine that. So that's why I'm not half surprised. Even the hawker center now, things are going crazy. Look at this one. It's a Nescopi. Wow, $2. My goodness, $1.50 was just last week, apparently. Oh, this is really incredible, guys. What can you do? Stop eating? Stop drinking? You can't. So make more money from the market. Makes sense, right? Let's continue. So disclaimer apply as usual. Let us make sure that we know what you're looking at. And thank you, AIMS, for the kind sponsorship. So let's recap what happened last night. The Dow Jones recovered 316 points. Wow, further upside yesterday. Nasdaq up by 1.42% or 108 points. S&P back above 4,000. Congrats to those who are buying. Not me, I didn't buy, but at least, you know, I am happy for you who bought. We can see that across the board, Apple is up, Google was up, Meta was up, Amazon was up. So across the board, wow, okay, those being beaten down as they recovered. But I thought we were going to have a FOMC meeting tomorrow. Okay. Now even Tesla up by 7%. Wow, up to 197 again. So same thing, guys. Tesla aiming above 210 for the next few months is a sell. I just repeat myself here. So what led to this recovery or this rally? Well, apparently now seemingly the stress, the what do you call unhappiness, or the what do you call the worry of the banks has had to mellow down. Well, we just have a problem just last week, right? A huge problem, and you're telling me now we are okay? Oh, well, apparently, seemingly like that, the beaten down banks have basically, like First Republic, right, was up by 30% after a day of losing 47%. Wait a minute, guys. You lose 47% and you go back at 30%, it's not a recovery. In fact, it's less than the original 47%. Give you a simple idea, right? $1, if you lose 20%, is 80 cents. From 80 cents, you're up by 20%, the same number is back to 96 cents. So this is not a recovery. Of course, the SPDR Regional Banking ETF, KRE, gained 6%, and I called for buy last week on this, so I was correct on that. Now, what's the main reason? Because Janet Yellen, the Treasury Secretary, says that the government is ready to provide further guarantees of deposit if the banking crisis worsens. Wow, okay. So that is the reason, yeah. Now, the thing is this, why is she doing that? I'll tell you more in detail. But the thing is this right now, right, the market is actually pricing an 86% chance of a quarter-point rate hike. Now, only 13.6 is looking for a pause. But you must understand, just 1 month ago, we're looking at 50 basis points, okay? So now we dropped to 25. You're telling me that things is better? Come on, guys, let's just be realistic here. So imagine now someone really asks, what if the Federal Reserve decide to pause it instead? No, they can't pause it. If they pause it, that means that they are acknowledging that they know something bad, and that is what the market doesn't want to know. You do not want the market to freak out, and that's the reason why they will do the 25 basis point regardless, okay? So that's the reason why you can see the stock market basically climbs up all the way throughout, especially the last 1.5 hours. It's a usual thing that you can see the market been doing every other time, all right? So even the analysts now are getting bullish, okay? Look at it. But this is from Game of Trades, one a YouTuber. Apparently now the analysts estimate that the Q4 2022 to 2023 Q4, the one whole year in short, they are expecting the earnings to recover. Now, I really have my question mark here itself, because we all know that, right, when you have recession, how can your earnings be better? So of course you may say, what if there's no recession, right? Okay. Now, I don't think so, because you can see that every time when the earnings are going down, look at it, my friends, okay, you do see that we will have a recession. So how can you don't have a recession? Correct. So the thing is this, now we are going below and we're coming down. Obviously, we should have a recession soon first. So to me, this is really nonsensical. But of course, again, everybody is entitled to a view. Maybe I'm wrong. Maybe I'm wet behind my ears, but I rather be safe, right? So to me itself, okay, I'd like to hear some expert. What do they have to say? Maybe I have missed out something. Let's take a look.
Well, we like both, right? The US banks, particularly the mega cap financials, those are the segments that we're looking at, because of the fact that they have less of a concern about the asset versus liability management issues that we've seen in the bank failures that happened 10 days ago in the US. And also the fact that as the regional banks have more issues at hand, the bigger banks are likely to grab market shares.
So when you take a look at banks that you think are not at risk from any sort of systemic or contagion risk and are showing good value at the moment, how do you make that decision?
Well, the mega cap banks, like I said, because they don't have, well, they have less of these asset liability management issues. And the fact that their income stream is much more diversified, they have asset management, they have wealth management, and those, also the fact that some of them have investment banking capabilities. So if you think about it, we're at the stage of the cycle where the economy is like slow, and you're probably going to see more M&A pickups and ECM and DCM, happenings.
I don't know whether I can agree with this guy here, so I'll be honest. I mean, of course, yes, indeed, the bigger bank, they have better so-called diversification. But do you really think that if, let's say, the whole economy go into recession, would the bigger bank be escaping from this? Seriously, would there be any more IPOs launching? I gotta give my doubt, honestly. So I just want to leave it down there, guys. You guys are smarter than me. You should know where am I coming from on this. Because let's remind ourselves how SVB got into trouble first to begin with. Now, SVB got into trouble because they basically bought a lot of bonds at a very low price back then, okay? Where the bond at a very high price while the yield were at a very low level, okay? So which means that they purchased a lot of bonds right here where the price is. Let me just get the drawing here. They bought it somewhere around here. So because they bought so much bonds at a very low yield, right? So there is a problem, because then after that, when the yield goes up, what happened? The bond price really goes down pretty badly. So all this tells you that there is a problem, because I'm pretty sure not only SVB has done that during that period of time. I'm pretty sure with the helicopter money of almost $5 trillion from the Federal Reserve, many companies also done that. And of course, when the money goes to the economy, a lot of people come in and put it in the bank. All these are pretty clear that this is going to have a very clear, big problem coming in. So now take a look at SVB. They increased their lending to insiders ahead of the collapse. Come on, man. How can you save these people? Honestly, this is moral hazard here. Look at it. They actually loan out so much money to insiders before it collapsed. So does it tell you that they know something? Of course they know something. They know that this will collapse. They know that this is going to happen. They know that they will be bailed out. And that is the problem here. And that is why I think that Wall Street is a place whereby big boys are really not good people. Now take a look right now. You can see that with the deposit rate now is increasing. Why? Because the money fund rate is so much higher. Imagine now, if your money is out, you put in the bank, get yield less than 1%. What you put in the money market is at 4%, even 5%. Of course, they will take out the money and put it into the money market. So it's undeniable to see that why there's so many people basically withdrawing the deposit to put into other places. So that is why now think about this. If the banks basically rely on this deposit for day-to-day operation, and now people are withdrawing from the bank because they want to put it into a better place, which Federal Reserve have done it, of course, you will have a problem. And incredible, let's take a look, guys, incredible that every time when you actually see this, whereby you see deposit actually being withdrawn out, right, it's always near a crisis period. Can you see that right now? 1979, okay, 1999, and 2009. Oh gosh, tell me about it, guys. Okay, so my view is very simple, guys. This is no joking matter. We're going to see problem coming out, because now you have basically a very clear avenue for people to take their money and put it somewhere that can yield them more money than not. And because of that, now you should understand this. Definitely now the domestic banks will start to tighten up. That means that they'll tell the commercials and the industrial loan to the smaller firm that, look, we are going to basically tighten up, okay? Because now money is not that much as compared, so we need to be very prudent with our loan. Now, guys, this is the 80 level, okay? Every time when we see this, come on, man, it's recession. This is something that you cannot lie to yourself, guys. These are real numbers, real figures, real chart. And I spent hours compiling this for you. And that's the reason why am I saying that unless something dramatically changed, if not, we will see recession by August 2023. Okay, I can write it out again and again. Recession, okay, will likely be happening by August, okay, 2023. Yes, indeed, the official. All right, but again, the market will likely hit a sell-off by June, okay? A June sell-off. Why? Because always always, market will always move downwards first before the official recession. Okay, so this is something that I want you to consider on this. Okay, all right. Now look at this. This is the unemployment data versus the tightening of the bank loans, right? So the problem now is this, guys. Look at it. Every time when it's tightening effect, the unemployment data will go up. Can you see that? Every time. Okay, it is something that you cannot run away from this. Every time when you have tightening issue, the unemployment will go up, tightening, unemployment go up, tightening, unemployment go up. Why? Because when the smaller firms cannot get loans from the bank, or the bank insists that they repay back, or they charge them higher interest, the small firm will start to release people. Survival, right? Then, of course, a big firm will start to cut too, because they are so big right now. If they cannot get any loans to sustain them and the earnings is not there, global recession, they will also release people. So there will be a sudden increment of unemployment rate. Now, that is something that what Federal Reserve is doing it right now, because they really want to curb inflation. Inflation can only be curbed when you have unemployment going up. Correct. So that is something that you must understand will naturally happen. And Federal Reserve is doing what they're supposed to be doing. So why are we so surprised? We shouldn't be surprised at all. In fact, this will just naturally happen, guys. So with all this information as well, right, I'd rather be very careful moving forward here. I know that people are bullish, but let's just take a look here. The CPI data, the unemployment data has shot up, okay? From 3.4, suddenly it jumped to 3.6, okay? The market didn't really focus on that because the market was on the banking side, but still, I believe the next one will be 3.7, and then after that, we'll see 3.8, 3.9, 4.0. So when this is happening as well, right, you will see that the GDP numbers start to decline, and of course, that will be recession. So of course, we all know that now Federal Reserve is caught right now between inflation and a banking crisis. So of course, again, I'm not the best person to tell you anything here. Let's hear what the expert have to say. Let's go.
And a rate hike. So what are we expecting?
Well, we're expecting the Fed to wrap up the second day of its two-day meeting and Jay Powell to come out and explain what they have done. Communication is going to be very important in this decision, no matter whether they decide to hold off, watch the landscape, see if the steps that have been taken that have calmed the market, allowed all those things to happen in equities and bonds that Emily was just outlining, or if they decide to go do the hike. That's the other side of it. Now, markets, I think it looks like, the Credit Suisse UBS deal seemed to do a lot to make people think, well, maybe they can do this rate hike. The 20 basis point rate hike means they almost are leaning for sure for the 25, but not quite. But definitely that's where people are leaning now. The dot plot, how are they going to do the dot plot, right? We're uncertain about where the markets are going. We're uncertain about if this financial banking turmoil is over or not, but they're going to have to put dots out. There was once during the pandemic where they didn't put out dots, and the concern is if they don't do that, once again, that's the kind of step and make people think, ooh, the Fed's really worried. So it's not telling us where it thinks its rate hikes are going this year. Right now, the terminal rate is seeing about 25 to 50 basis points higher than it is now. 4 3/4 is the funds rate. That would take it up to about what, just over like 5 1/4. And the consensus dot has been 5.1, but just think what we were talking about the last couple of months. Oh, maybe it'll be 5.4, maybe it'll be 5.5, maybe the funds rate will have to go to 6. But we know, look at this chart, financial conditions are tightening. Do you have to raise rates as much if financial conditions are going to do some of the work for you? However, if this does settle down, if investors, if depositors are willing to keep their money in their banks, well, then maybe this will ease up a bit. But for now, it certainly signals that caution is warranted.
All right, you heard for yourself. If the depositors stay, things are still okay. But if the depositor leave, we will have a problem. And when that happens, the bank will definitely apply the credit crunch. This is why my statement today is there will be a credit crunch coming in, because the Federal Reserve had to increase interest rate because to curb inflation. Hence, therefore, the yield will be still going up, right? So when that happens, as a depositor, I realize that I have a recession coming in. I need to protect myself. I need to buy some stocks. If I got the government is going to take care of me in a way, regardless, it will be very safe. So I will take out my money from the bank and put into the bond market, because that will give me real return. And because of anything happen going forward, the government says that you protect me at all costs, right? So definitely there will be that credit crunch coming in. So now you understand why the market now, after a while later, they realize that they cannot have a pause. They basically buys into that there will be a 25 basis point. So you get it? This is how the things swing again. So, but the thing is this, market is pricing that there will be a rate cut soon later this year. And the thing is that the numbers are quite incredible. You're looking at it at pretty fast stage, all right? So no, I don't think so, guys. I really don't think so. In my opinion itself, right, we will not see this so fast. But the market is like, trying to calm everybody, say, you know what, things are good, don't worry, blah, blah, blah. Sorry, I don't buy this. That's how I feel it right now. Hopefully I'm wrong for you guys. All right, because you can see, right, how it swung within just a month. So just a month ago, okay, we have a 75% odds of a 50 basis point rate hike. Then suddenly, because of SVB, bang, the whole thing collapsed down. Let's take a look. The thing collapsed down all the way. And then the market was saying that, you know what? We could have a pause, no more rate hike. Because if that continues to hike further, we may have a Armageddon in terms of financial. But after a while later, they say, hey, you know what? With Janet Yellen, with the Federal Reserve, FDIC, UBS coming in to save the day, the market say, you know what? If we can save the day, let's continue the rate hike. This is how crazy it goes, guys. So I'm not surprised that if the CPI data or the inflation data will continue to raise up, right? You're going to have, again, the same speculation of another 25 basis point coming in. And that's something that the market is not looking at right now, because the market is looking at 25 and we pause. No, it'll be 25 plus 25 plus 25. I'm going to write it down again here. I believe that we'll see 25, then another 25, and another 25. Only when the third 25 hits the fence, then maybe you have the real shakedown, and that's where by June, July period. And when that all happens in South, the market will freak out, earnings will be terrible, and the bank will say, you know what, no more lending, bam, market will just sell down all the way to June period. And then after that, you have a freak out period. And of course, that's where you could pick the low hanging fruits. And that's where you buy, and you buy. Yes, indeed, you heard me correct. You buy, and you buy, and you buy. And then after that, by August, we have the official recession where the whole world tell you that it's terrible. But then again, because you bought it cheap, you have got it right, get it away from that. And after that, enjoy the write up. Yes, indeed, the write up itself. So guys, if you think that you believe in what I say, or you do have the same feeling, put in the comment box. I'd love to hear what you have to say. All right, it's so important. All right, let's look back what happened after every FOMC. So apparently, after every FOMC meeting, we have big movement, okay? Pretty sizable movement, like see here, right? The FOMC of the meeting, after that, we have big sell-off. Then the next FOMC, we have big recovery, big sell-off, some sell-off, and then some sell-off, recovery. Okay, so if you look at this as an odd game, right? Every time where you have FOMC, most of the time the market sell off because we have the Federal Reserve coming in about rate hiking and stuff, right? That's understandable. So what do you think? In my opinion itself, there will be a sell-off, okay? Because why? The last few days, the market has been going up, more like preparing for this. So of course I can be wrong, but I'll just basically watch this very closely, guys, okay? Great, pretty cool, yeah? Okay, great stuff, let's continue. So do I believe in this lady's word? I'm so sorry. You know why? Because Janet Yellen actually said, I don't see a financial crisis occurring in our lifetime. Now, this is something that she said. She said our country financial sector is very much stronger than like years ago in 2017. And the flip of the eye, 6 years later, now she's basically telling the whole world that, you know what, let's vow towards this. The safeguard of deposit, we are okay, we'll intervene, we'll do this, we'll do that. Hey, come on, man. If you had done your job properly, or you've done your administration has done it properly, then you won't have to go through this. But obviously, we know that this is something that probably they have already orchestrated. Now, yesterday, I think you guys have heard it for yourself. Honestly, I felt that the way the banks are coming down right now is too fast and look very, very suspicious. It's like it seems like they just crashed down just like that, okay? And then all the depositors' money just gone in a way, right, in a way. But of course, now the government coming in to save the day. And then the best thing is that the government almost ready to protect and make sure things go back to normal. So fast. Looming itself is a very big conspiracy here. I just feel that, right, it's on purpose. It's really on purpose to basically do a reset. What do you think? I just feel that way, okay? So now we saw the discount window. That's something they don't borrow from the Federal Reserve, but now the banks are doing it. Yes, surpassed 2008, okay, level. That means that now we are much higher than 2008 and the pandemic period, that means the problem is bigger than we all expect or we know. So that means that the Federal Reserve or the governments are not telling you the truth, okay? They know that this thing is going to get very bad, okay? So that's the reason why now you can see there are, the borrowing is really incredible, okay? It's really non-stop here itself. So that's why be careful, guys. So this lady, okay, not this one, okay, this is a presenter, a former Bridgewater CIO, okay, actually says that the market is mispricing the Federal Reserve policy. I really like her way she really share her view. In fact, to me, it's straight to the point and it's pinpoint. So let me show you now. This is something good for you guys. Let's watch this.
Rebecca Patterson is the former chief investment strategist at hedge fund Bridgewater Associates. Rebecca joins us here on set. Of course, she's been in the Fast Money family for a very long time. So we welcome you back. Great to have you here in person.
Great to be here.
What is the market mispricing at this point? I mean, the fact that we're rallying into this Fed meeting?
Well, I think the whole desk, you all covered it really well already, and Rick did as well, that tomorrow, who knows? We can make educated guesses. Do they go 25? Do they pause? How did the language go? But the bigger deal, the bigger issue for investors are these rate cuts getting priced in later this year and a pretty rapid pace. And, you know, in 1987 and 1998, we saw that sort of quick pivot to easing. But back then, the Fed didn't have the toolkit it has today, and it didn't have the inflation problem it has today. So for the market to be right on rates and the Fed to pivot that fast, I think you all said it really well. We're either going to have to see a lot more financial stability or instability, which obviously is bad for stocks, or the economy is going to have to slow so quickly that it brings inflation down close or below target in months, which, I mean, given that core CPI is still 5.5%, wages are still growing 6%, again, it's going to be really bad for earnings. So I don't see a scenario where rates are right and equities are right.
Once upon a time, and I think this was like 2 times ago, when the markets were pricing in a cut at the end of the year, and this is before they bumped it to next year and then bumped it back to this year, he actually guided and said, I don't see that happening in the back half of the year. And I wonder, you know, is he going to go out on a limb and actually try to manage that market expectation now? I mean, that would be an interesting market reaction to see.
Yeah, I mean, there's going to be the inter-day trading that we get tomorrow and probably the day after as people parse the press conference and the dot plots and the new forecasts that come out. But again, I think if you're trading the intraday, you've got to focus on that. If you're looking out over the next 3 to 6 months, to me, this is very easy. It's not confusing. You lean into rallies and sell them.
You heard it again, you lean into rallies and you sell them. All right, it's pretty clear, very direct. I love the way she wrapped it up. Impressive, okay? Now, normally I don't really buy these Wall Street guys, but for her itself, I salute and respect. The full video will be uploaded onto this Trade the Boys Facebook page. You can watch it later on your own, yeah? So with that assessment from her right now, right, it gave me even more stronger validation that I believe that what I'm seeing is actually spot on. So what is the market credit? What is this credit crunch? Okay, first of all, you must understand M2, okay? M2 was at a high in 2021. Suddenly, there is an incredible pullback of a ridiculous speed that have brought it down to the negative zone, guys. This is absolutely insane, okay? All right, so now the economists at Goldman Sachs estimate a tightening in lending standard due to the industry stress that were equivalent to a 1/4 to a 1/2 point increase in the Federal Reserve benchmark rate. So what I'm trying to say is this, guy, even Goldman Sachs is telling you guys that there will be a credit crunch very, very soon. And what is this credit crunch all about? Again, let me break it down to simple notes for you. Let's take a look. So a credit crunch is a significant tightening of lending standards among banks. Loans are harder to get, very critical, and become more costly or expensive. And the banking crisis triggered by a failure of the SVB and Signature Bank will likely lead to a small and mid-sized institution to prioritize having a healthy balance sheet. So this is what is going to happen, and we know as SVB and Signature Bank. Now, I want you to focus these 2 banks first. Later on, towards the end, there's something I'll share with you from Michael Burry. So if you look back, what happened, right? Every time when there is a credit crunch itself, things will get very scary. Now, what is a credit crunch in terms of back then in 2009? Remember 2009? Okay, the crunch occurred because of years of lax lending, inflated a huge debt bubble. People borrowed cheap money and plug it into property. So guys, isn't this the same thing? We have a many years of incredible lending from the Federal Reserve. We have basically got in a huge debt bubble that is causing inflation is happening. And then this cheap money is at low percentage rate, is being poured into property. That's why property prices are going sky high. So all these tell you that this is a repertoire of what happened back in 2008, 2009. All right, it is happening again. Now, like it or not itself, guys, you can say that it's all is different because the people involved is different. But come on, guys, let's just be realistic here. So today is all right. Back in July last year, already in Bloomberg, a coming credit crunch coming in. Apparently, this is something that was mentioned since July last year. And I told you guys this likelihood that when this type of thing is going to happen, it takes about 1 year for it to really manifest. That means the real problem will only happen 1 year later. And now, if you look back what I just said moments ago, I told you guys, June, July period, we will have a problem. And it's really happening right now. This is really insane. This is something that you cannot run away. So that is the reason why, if you look at it now, this is the ICE, Bank of America, BBB, BBB, US Corporate Index Option Adjusted Spread. I know that this is like a mouthful here, but the key point is this, okay? This is actually the performance of the US denominated investment grade rated corporate debt publicly issued on a US domestic market. Now, this subset include all securities with a given investment grade of BBB. And now these numbers are increasing, and every time when this is increasing, this will not end well. Okay, guys, this is something that you must understand, and we are now increasing, as you can see. So it will take some time to see to that level that I mentioned, but I believe there'll be 3 months down the road. So all this thing is that what you don't see from the mainstream media. Everything here I share with you is off mainstream, and of course, combined with some of the mainstream guys, you can actually feel why am I so concerned right now. So of course, again, I can be totally wrong, and maybe you're gonna have a greatest bull run of all your lifetime. But I believe that in numbers, I believe in rhythm. I believe in market patterns. I believe in price action, and most important, I know that Wall Street is a place whereby they'll need to lie to you for them to get out of the market. So take a look at the S&P technical chart right now. Tell me this is not orchestrated. Tell me that this is a breakout zone. Well, by right, we have a strong support at the Fibonacci level here. The market missed 3,800 and now it's going up, right? Okay. So a lot of people now believe that this is going to go through the roof and go back to 4,200 again. Now, this is possible if the Federal Reserve really want to bring this up. But if not at technical, this is point A, this point B, this point C, and we are at point D. And if you ask me right now, I prefer to sell than to buy. But of course, I can be wrong. If the market chooses to go higher itself, okay, be it, I may follow through the buy. But at least for today, tomorrow, I think it's better to take a sell position, sell on rally, than to buy instead. Again, that is my personal view. I leave it to you. Now, to wrap it up for this video, take a look, guys. This is something very interesting. This is basically to show you the bank bankrupt. Okay, so we know that Signature Bank is down. We know that Credit Suisse is down. SVB is down. Silvergate is down. But of course, there's still a lot of banks that are still okay, right? Well, look at this chart from Michael Burry, and you can see why SIVB, SBNY are in the list, and of course, things have happened. Okay, so to me now, right, if you ask me who am I watching very closely, right, it's definitely this guy here. Sorry, let me change the color for you, make it bigger for you. Very important. This guy here. This guy here, this guy here, and probably this guy here. Okay, so this is something that I feel that you should be very careful. And of course, those who are on the safer side, you're okay. But those are on this side of town, I think that you need to watch out for this. Okay, all these guys are something that it should be really heavily watched because things can get really, really scary. All right, guys, hope you enjoyed this video. I think I did a very decent job out here today covering all these important aspects. I'll see you guys on the technical side. This is Cal signing off. Bye-bye.